This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 510 was produced on December 11th, 2025. I'm Eric Townsend. The widely anticipated December rate cut finally happened, coming in at 25 basis points, with Moran dissenting in favor of 50 basis points instead of 25. And I can think of no one better qualified than Bianco Research founder Jim Bianco to dissect what just happened, what it means for markets, and what comes next as the Trump administration continues to press hard for lower policy rates, on the foregone assumption that they can only lead to lower long-term borrowing rates farther out on the curve. A myth that Jim Bianco will dispel in this week's feature interview. Then be sure to stay tuned for our post-game segment after the feature interview, when Patrick will translate Jim's views into an asymmetric trade.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, December 10th, 2025. The S&P 500 index up 54 basis points to 6886. Market trading along highs going into next week's key economic news. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index down 24 basis points, trading at 98.63. The January WTI crude oil contract down 152 basis points, trading at 58.46. The January RBOB gasoline down 273 basis points to 178. The February gold contract up 21 basis points, trading at 42.24. Precious metals remain well bid, with silver leading the way. March copper down 74 basis points to 535. December uranium up 164 basis points to 77.25. And the 10-year treasury yield up 3 basis points, trading to 412. The key news to watch next week is the much anticipated delayed jobs data release, the retail sales, flash manufacturing and services PMIs, the CPI, and PCE price index inflation numbers. This week's feature interview guest is Bianco Research founder Jim Bianco. Eric and Jim discuss market signals, bond vigilantes, inflation, and more. Eric's interview with Jim Bianco is coming up as Macro Voices continues, right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Bianco Research founder Jim Bianco. Jim, what a perfect time. We're speaking Wednesday afternoon, just literally minutes after the Fed press release. We've got a cut, which was expected, some bill purchases, which some people expected. And I think it's also important to talk about the divide. You know, this was not a unanimous decision of the Fed. What is, in your mind, the signaling of a split Fed on a decision like this that was widely anticipated? Let's cover all those things.
All right. Well, let's start with the cut. The Fed cut the funds rate by 25 basis points for a total of 175 basis points since they started cutting in September of 2024. They kind of left the door open to the idea that they might be done or pausing for a while. The dot chart, which was updated, or dot plot, which was updated, only shows a median of one more rate cut for all of 2026. Of course, there's 8 meetings, one rate cut. I mean, 7 of them, you're not going to get a rate cut if that's indeed what they wind up doing. The other thing they announced, as you pointed out, they call it reserve market purchases, RMPs. Don't call it QE. They're going to buy $40 billion of bills, maybe out to 3-year notes if necessary, but mainly bills, a month going forward. Now, what's that all about? The Fed has been doing quantitative tightening. They have reduced the size of their balance sheet, which also reduces bank reserves, to the point now where the funding markets are not big enough for the underlying treasury market. Remember the funding markets, the repo market and everything else. What is their purpose? To finance the $38, $39 trillion treasury market. They're not big enough to do that. There's a tightness in that market, and those rates have been going up. So the Fed announced $40 billion of buying to try and add more reserves into the system, give banks more capacity to hand out more repo loans to meet the size of that market. Now, the pushback I'll give you, is stop there real quick before I talk about the vote. The question that everybody's been attacking has been, I think, from the wrong side. They've been saying there's tightness in the repo market, so the Fed's got to do quantitative easing, reserve market purchases. They need to change the supplementary leverage ratio or maybe expand the standing repo facility or all these other things to accommodate the funding market to meet the needs of the Treasury market. And I've said, but no one's turning it around and saying, maybe the funding markets are giving a signal that the Treasury market's too big as opposed to the funding markets being too small. And that signal is, Congress, you can't keep borrowing. You can't keep borrowing at this level. You can't keep running $2 trillion deficits and keep with these massive budgets. Because if the Fed were to expand the funding markets, which is what they're doing, maybe they're sending a signal to Congress. Go ahead, keep running these big deficits. Go ahead, expand your budget, start new programs. And what's the concern there? I think that in the post-COVID environment, after the supply shock of 21 that caused inflation to spike into 22, the next biggest driver of inflation is government spending. And if the repo market or the funding markets were too small, saying you got to back off on the government spending, and our answer is no, we have to expand the repo market so they can continue the government spending, then we're going to be worried about that they're just encouraging or enabling more government, which enables higher inflation. Finally, as you pointed out, the vote was 9-3. That's the first time since 2019 that we've seen 3 dissents, and they were two-sided. 2 dissenters, Schmidt of Kansas City, Goolsbee of Chicago, dissented that they did not want to cut rates. And Stephen Marin wanted to cut rates 50 basis points. So we had a hawkish dissent and we had a dovish dissent. But going into this meeting, the expectations were for a bigger amount of dissents. I'll quote Nick Timmeros, the Wall Street Journal Fed watcher, yesterday's paper. He pointed out that if you listen to all of the Fed speak since the last meeting on October 29th, there's 19 members of the Fed, 12 of them are current voters, they rotate the voters. 10 of them have come out with statements or that they are uneasy about continuing to cut rates. And 5 of them were voters. But we only got 2 dissents against cutting rates. And overall, we got 6 soft dissents. Now, what's a soft dissent? The Fed put out its dot chart again today, and there was still a 25 dot plot in there. And 6 of those dot plots were for 3 7/8, which was the rate before the meeting. So 6 of the members put down as their dot that the Fed should not be cutting rates, although 10 of them have given speeches suggesting it, and only 2 of them dissented. So a couple of these members that said that they didn't want to cut rates actually relented and went along with it. Now, why is that important? Because in May, we're going to get a new Fed chairman. Kevin Hassett seems to be the leader in the clubhouse right now. And that Fed chairman is presumably going to do the bidding of Donald Trump, who has made it very clear he thinks that the funds rate should be a lot lower than where it currently is. There's a number of Fed officials that are more concerned about inflation to continue to aggressively cut rates. In theory, they could stand up and push back and say, yeah, but you're only one of 12 votes, new Fed chairman. Who's the other 6 that are going to vote with you to give you a majority? Because we're not in agreement here with you that we should be cutting rates, which is all fine and good. But if they wait until May to finally push back on that, the Fed looks highly partisan because you waited for Trump's guy and then you got a spine with all your dissents. But when we had Powell and before him Yellen and before her Bernanke, you never dissented on any of that stuff. But now with Trump's guy, you're dissenting. And so they would have been better off, in my opinion, having a 7-5 vote now to kind of show, look, we're pushing back, but he had enough to get the cut through. But we're really of the opinion that we shouldn't be aggressive with these rate cuts in the future. Note to next Fed chairman. But they didn't do that. And I think that might come back to haunt them when we get that next Fed chairman.
I'll come back to Kevin Hassett in a few minutes, but I want to go back right now to some of the comments that you made a few minutes ago about how the market is responding to the government continuing to run all these deficits. It sounds like you're saying, okay, early stages of bond vigilantes showing up in fighting armor might be, starting to show their faces. Is that what you meant? And I guess if so, the qualification, I think, is, boy, for any sane thinking person, we've all felt for the last 20 years like U.S. government spending is out of control. Surely the bond vigilantes are going to show up and it's all going to be, force their hand. But that hasn't happened in the last 20 years. So what would be the changing factor that would cause bond vigilantes to actually be able to change or to force the hand of the government? And why hasn't that happened for the last 20 years?
I'd say for the last part of the question, the last 20 years, let's say pre-COVID, no matter what we could do, we couldn't get inflation above 2% to any great degree, except for brief moments here and there. So we were always in a very low inflationary environment. So the bond vigilantes really had nothing to be vigilant about. But in the post-COVID environment, we are 5 years. We are approaching the 5th anniversary of the COVID shutdowns right now. The 6th anniversary is coming in a few months in February of 2026. And the inflation rate is still 3% or higher, depending on which ones you look at. So they can't get inflation below 3 now, as opposed to above 3. So the bond vigilantes, I think, are, as you pointed out, putting on their armor and starting to push back. Now, I would argue, again, what I said before, 175 basis points of cuts, and the 10-year note is 55 basis points higher. On top of that, I would point out that gasoline prices in the last couple of days have now broken below 3% as $3 as national average. That is the first time since the Russian invasion of Ukraine that we have seen gasoline prices below $3. So that alone should have been very bullish for bonds. So you've got falling gasoline prices, you've got 175 basis points of cuts, and you've got the 10-year yield higher by 55 basis points while all that's happening. That sounds to me like a real pushback in terms of bond vigilantes, even though you might say, but it's still 4.15, it's not 5, it's not 6. Yeah, but they've ignored what should have been incredibly bullish stories for bond yields to fall quite a bit, and they haven't. So, yeah, I think that the bond vigilantes are out there in force right now, and if we continue to push, hey, we need more cuts, we need to be cutting by 50. The president criticized Jay Powell after the press conference saying that they should have cut 50 basis points today and not even be talking about being close to being done. That the bond vigilantes are there, that we should probably be in the low 3s right now, all things being equal, but we're at 4.15. So there is an impact from them.
Let's stay on inflation before we come back to Kevin Hassett. Obviously we just got a 25 basis point cut, but more importantly, as you say, starting in May, President Trump has been super clear. He wants a lot more cuts. He wants to see 1%. Cut, baby, cut. Well, obviously the textbook fear is that really starts to unleash inflation. I suppose the counter argument to that would be, well, while that does unleash inflation, it won't unleash any significant inflation before November's midterm elections. And I think that's probably what's driving the president. So do we have a setup here for cut, baby, cut that sets up a big inflation response, which maybe doesn't actually kick in before those midterm elections, but boy, it seems to me like we could have a setup for inflation to start to run away in late 2026 into 2027. Am I right to think that?
Yes, for the inflation statistics. The inflation statistics are officially classified as lagging indicators, so they will take some time to kick in and show the inflation. Bond markets are forward-looking. They're not going to wait for the inflation. They're going to anticipate the inflation. So if you wind up cutting too aggressively and the markets are worried about inflation, they'll react to it almost immediately. And that could be the story of 2026 if we were to wind up getting a single-minded focused Fed chairman who wants to aggressively cut interest rates. By the way, let me talk about that inflation by diving off a little bit into the labor market. Why did the Fed cut rates? What is the Fed most concerned about? They're concerned about that jobs are falling, that a year and a half ago, the U.S. economy was cranking out 150,000, 180,000 jobs. The beginning of the year was still churning out 80 to 100,000 jobs. Now it's churning out somewhere around 10 to 30,000 jobs. And I say that somewhere because we don't have the official statistics because of the government shutdown. They're still only current through September. We're looking at things like ADP. We're looking at things like Challenger Grain Christmas layoff announcements. We're looking at some alternative data to that degree. So the Fed is worried that the labor market is producing less and less jobs. Absolutely true. But they only give very short notification about what the Fed calls labor supply, which the market calls the break-even rate. How many jobs does the U.S. economy need to create? The biggest driver in deciding that number is the population growth of the country. So if you go back to 23 and 22, when we were cranking out almost 200,000 jobs a month, the population of the country was booming. Why was it booming? Because of undocumented workers and illegal immigration. We were getting 3 million plus illegal immigrants into the country a year in 2023. That was making the population of the country swell by more than 1%. Today, I'll go with the numbers that Trump used at his cabinet meeting last week, and he's repeated these numbers many times, that the illegal immigration into the U.S. in the last 6 months, he says, has been zero, not one person. He also says 2 million people have deported. 500,000 of them have been through ICE arrests, and 1.5 million have self-deported. Now, he's not showing his work. We don't know if those numbers are accurate, but conceptually, they are accurate. We do know just from watching the economy, the number of undocumented workers coming into the country is down a lot. The number of people being deported versus last year is up orders of magnitude. Whether or not it's 2 million and zero or some number near that, we don't know. But that brings up an issue that it's possible that the population growth of the United States is either zero or negative. In the 250 years this country has existed, there's only been one other year that we've had negative population growth. That was 1918, the Spanish flu. We got close in 2020. We got down to like 10 basis points of growth. We didn't even have negative population growth during the Civil War when we killed 6% of the population of the country because the fertility rate, the average woman had about 6 kids. That's why we didn't have negative population growth. But we could be having it for the second time now or something very close to zero. If you don't have population growth, Paul actually said this, if you don't have population growth, you don't need a lot of jobs. And we might be cranking out 20 or 30,000 jobs a month. We don't need many more than that. And if you are cranking out 20 or 30,000 jobs a month, every other or every third month might be a negative month. And then you have a 50,000 month to kind of offset it there along the way. If that's the case, and the Fed is cutting rates because they're worried about the labor market, they just cannot make that jump. Yeah, we're producing 180,000 jobs a month. Now we're producing 30, but we only need 30 or 20 or zero, and we're okay with 30. So don't worry about the labor market. They can't make that jump. They're saying, what if we're wrong? What if the labor market keeps sinking? We got to keep doing what Powell has referred to as risk management cuts, and they're not necessary. Then all that stimulus is just going to go in the prices and push inflation even higher. So that's really the question about the labor market and about how inflation fits into this. How bad is the labor market right now? And to answer that question, you have to ask the question, how many jobs do we need? Is it zero? Is the break-even rate zero? Any positive number is okay. Again, over a 3 or 6 month average, you can have negative numbers in there and some positive numbers in there as well, too. That is really the open question. And if we come to the answer that, yes, it is somewhere near zero, yes, 30,000 is enough, all these rate cuts are just going to go towards inflation. And we know everybody's angry about affordability, and you're just going to push inflation even more. That could become a real problem.
Help me if I'm misinterpreting the news flow here, because what I think I've heard is a few weeks ago, President Trump announced, okay, look, The fix is in. It's a done deal. I've made my final decision who the new Fed chair is going to be. I'm not going to announce it till after the end of the year, but it's a done deal. It's decided. That's it. And then this week he started interviewing other guys for the job. So, okay, did he change his mind? What happened? I think almost everybody in the market assumed when he said that his decision had been made that he was talking about Kevin Hassett. So I guess I should ask first, do you agree that's who he meant when he was saying that the fix was in? How come he seems to be backtracking on that? Is it no longer a certainty that Kevin Hassett is the pick? What do you think?
Yes, I think Kevin Hassett was the pick. I think that there is some doubt. If you want to go with betting market numbers, Kevin Hassett was trading mid to high 80s after that announcement came out that Trump has made his decision, and now he's trading 69. It's still above 50. He's still the favorite, but doubt is creeping in. Why is that doubt creeping in? As best I can tell is after it kind of became known that Hassett was going to be the guy, a lot of press reporting was corporate America and Wall Street was pushing back about Hassett, and they were unsure whether or not he should be the Fed chairman. Not because of his resume. From a resume standpoint, Columbia professor of economics, has worked in the White House, has worked at the Fed. He has got a resume that makes him qualified to be the Fed chairman. Question is, are we going to get the Kevin Hassett of the resume, or are we going to get Kevin Hassett, stooge of Donald Trump, whose job is to just cut interest rates and not even think about anything else? Wall Street and corporate America was worried we were going to get Kevin Hassett's stooge. And they were saying what I was trying to argue before. You cut too much, you're too aggressive, you might have a backlash in the bond market because you're not being sufficiently vigilant about inflation, and you could actually have higher rates. So what I think happened was Hassett, who's been out there almost every day, has been trying to assuage these concerns about the idea that he would overdo the rate cuts. And I think Trump doesn't like hearing that from him. Also, Trump likes the way that Scott Bessent, the Treasury Secretary, is a respected and calming voice in the market. And Hassett, while he's a very qualified and he's a competent person, he's not getting that respect from the marketplace right now. Seems like Trump is maybe having second thoughts, and he's opening up the selection process to interviews. But let's be clear. Question one is, what are you going to do to get the funds rate to 1%? How are you going to ignore anybody who gets in your way in order to get the funds rate to 1% is going to be question two. So he's not looking for an objectively minded person. He's looking for somebody who wants to be single focused in lowering interest rates.
Well, let's talk about the prudence of the president's agenda, because I can't believe he really cares that much about policy rates, which is what the Fed actually sets. I'm assuming the reason he cares about that is he's making the assumption that those policy rates translate. You lower the policy rate, it's going to translate to lower rates further out on the curve. As you've described, it doesn't always work that way. I'm not sure if the president sees that, but boy, if you imagine the Democrat Party saying, okay, we want to do anything we can against President Trump, how many economists could we round up to express publicly the view that aggressively cutting policy rates doesn't necessarily result in lower interest rates on something like mortgages or car loans or things that voters care about? It seems to me like there's a pretty large contingent of economists that don't really like the president who would be ready to take that view. And I think that, frankly, the way I understand monetary policy transmission is a lot of it has to do with the mood of the marketplace. So that kind of propaganda, if you will, could be very effective in maybe causing the back of the curve to respond opposite the way the president is assuming. Am I reading too much into that?
No, you're reading exactly into that. That is the concern, and there will be enough people that will come out, me included, that would say, look, aggressively cutting rates is going to backfire on you and produce higher long-term interest rates, because that's where mortgage rates are set, and that's where corporate borrowing is set, and those are the rates you want to lower. Remember, Trump has already said that he thinks he should be Fed chairman, but he acknowledged he can't be. He wants to appoint himself because he's a real estate guy. So that makes him, in his mind, an expert in interest rates. And in fairness to Trump, every real estate guy I've ever met thinks that they're an expert in interest rates. And they always have their expertise go in one direction. They're too high and they need to go lower. That's what every real estate guy thinks, because they think in terms of mortgages, because that's the way that they've cut their teeth. So he's of that opinion right now that he needs to see interest rates come down. And I still think that that's why he believes that the economy will boom if we were to see the Fed continue to cut rates, that eventually long-term rates, mortgage rates, all of those borrowing cost rates will come down. And if they've been slow in coming down now, Trump's ready-made answer is too late. That's what he calls Powell. You should have been cutting rates aggressively and earlier, and we'd have a much lower 10-year notes. We'd have much lower 30-year mortgages if we were to do that. Although I would argue, no, it's more about worrying that you're overcutting, worrying that there's an inflation problem, and that's what's holding it back. And the only reason we're down to 415 is drill baby drill seems to be working because gasoline prices are down, but you still can't even get the funds rate. I mean, the 10-year rate below when you started cutting the funds rate at this point. So yeah, I think that's exactly what it is that the president is pushing really hard on it, and there's going to be some pushback if that's where they're going to go in the future. That is, the new Fed chairman is going to be single-minded focused about being aggressive in cutting rates.
It seems to me that this is all a great big setup for the president to accidentally unleash. I think there's a secular inflation in the making anyway, but it seems like, it takes a catalyst to really get an inflation to run away. Didn't you just kind of lay out the game plan for creating that catalyst?
Yes. And that is my concern about why I think interest rates could go higher from here, because we're not talking about being vigilant about inflation. Jay Powell said today that every member of the Fed expressed a concern that inflation is too high. I agree with him. Not one member of the Fed, according to Jay Powell, has as their base case any consideration to raising rates in the future. Doesn't mean we have to, but think about what I just said. We're all worried about inflation, but we're not going to do anything about it because doing something about it would mean raising rates. And so that is going to be a real concern. And as a matter of fact, right before we started talking, Jay Powell said something at the presser too that was kind of interesting. He said that the inflation rate ex tariffs is in the low twos. Now, there is no measure called inflation rate ex tariffs. So obviously the Fed has invented one. They haven't shown their work as to where they come up with it. But I was looking at some of the breakdowns of the inflation numbers, and I was looking at CPI services because we're not tariffing services. That's above 3. CPI services less energy is above 3.5 right now. I don't know. Yes, he's correct. CPI goods, which is largely a lot of tariff stuff is in there, is rising rapidly. And that does account for the majority of the rise of inflation over the last several months. But if you take that out of the equation, services are still above 3%. I don't know where he comes up with the low twos. Obviously, he's got a measure that he came up with to come up with that. But I wish like the president would show his work about what the population growth of the U.S. is. I wish that Jay Powell would show his work as to how he came up with that low twos number of, inflation ex tariffs.
Let's talk a little more about inflations, particularly secular inflations, and how they work, because I could imagine, somebody from the Trump administration was listening to the two of us talking about this. They'd say, look, guys, come on, relax. We think that we can bring policy rates down. That should bring long-term rates down. In the unlikely event that Jim Bianco is right, and what really happens is that pushes longer-term rates up because of inflation fears, we can make an adjustment at that point. Maybe we'd have to hike rates in order to bring longer-term rates down, but we'll find that sweet spot and it's all going to be fine. I don't think inflation works that way. I think the way inflation works is once you start to see a runaway, not so much in inflation itself, but in inflation expectations, what happens is it changes consumer behavior. people start buying things now in order to, buy them before the price goes up. And all of the sudden, you get a runaway situation that's out of control and can't be stopped. It seems to me like we're playing with fire here. We're playing with matches at a time that we don't understand that the forest is really dry and potentially at risk of once something gets burning, we can't stop it. Am I exaggerating to think that's a risk, and what could go wrong here?
No, it's a real risk, and it's happening right now. And Jay Powell addressed this, and I disagreed with him there. There's two broad measures of inflation expectations. One broad measure is market-based measures. You can look at the inflation swaps market. You can look at the Treasury inflation protected securities market to back into what's called the inflation break-even rate. What is the market pricing in for inflation? So if you look at market levels of inflation, they're anchored, to use the Fed term. They're low in the low twos. They're not moving. They don't have a lot of volatility. And they would give the Fed and the administration comfort. See, the market-based measures of inflation are not a problem. But if you look at the consumer-based measures, the surveys, the University of Michigan survey of inflation, if you look at the political polls, the number one issue, according to the political polls, is affordability. The president's approval rating is falling because everybody's talking about affordability. What they mean is the level of inflation. CPI is up 27% since April of 2020. And they would like to see, some relief on these high prices. In their example, inflation for the public is unanchored, and they're very, very upset about it right now. Jay Powell dismissed it by saying that the inflation numbers are well behaved in the surveys. I'm like, we've only been talking about the University of Michigan being at 30 and 40-year highs in inflation expectation all year. I'm sure he's found some other survey that says that, no, that's not the case. But the big ones that we look at are showing that that's the case. And that really comes down to what is more important, that a bunch of bond traders aren't pricing in future inflation, or the public is tanking the president's approval rating and is spitting mad about affordability. I'm going to go with the public being more important than a bunch of bond traders, and that the public is the one that's going to lead towards unanchored inflation because they want something to be done. I'll say the last thing about this is, how mad are they? They just voted a socialist in this New York City mayor. They almost voted a congressman who is a socialist in a very red district in Tennessee, and they voted a socialist in the night before we're recording as mayor of Miami. So they're now turning towards socialists that are saying, you want affordability? I'll just cap the price. I'll just make it illegal for these prices to go up anymore. Does it make economic sense? No, but I just want relief. And if they're offering me relief, I'll take the relief, is what we're getting right now. So yeah, it is a problem. And just because the tips desk at Goldman Sachs is not pricing it in, therefore doesn't mean it's a non-problem.
Well, Jim, I couldn't agree with you more. Let's shift gears now and talk about the consequences of all of this stuff in markets. If you and I agree that there's a very significant risk that we're about to unleash a secular inflation, the first thought is both precious metals and crypto. Then I guess the next thought is, let's talk about what happens in a big inflation to the stock market. I think a lot of people, remember the 1970s and think inflation up, stocks down. I don't think it really works that way. I think it's inflation up, stocks up at first a lot, and then stocks down only after the feedback loops kick in. So let's get into what this is going to mean for markets.
Yeah, so let's start with the precious metals markets. Obviously, they're flying year to date. I'm just looking at my screen right now. Silver's up 110%. Gold is up 61% year to date. Silver traded over $61 the day we're recording at one point earlier in the day, and gold is still at around 4,200. They're not pure inflation plays. I don't think they are. What they are is they are uncertainty, bad things happening kind of plays. That's why you buy gold. One bad thing obviously is inflation. Deflation could be another one. Political strife could be a third one, and the like. And so the fact that gold has been moving up quite a bit has been a signal to the marketplace. It's worried. There's worried that there is a problem here. And a lot of that's been coming out of Asia right now, because you could actually argue that within Asia, the inflation problems and the worries are bigger. Japan has got a real inflation problem. For the first time in 50 years, Japan has a higher inflation rate than the United States. You got to go back to 1977 to find the last time that they actually they had a higher inflation rate than us as they do right now. China I've been a very big bear on China. I think that their economy is struggling. I think they've got a real estate problem. So that's been the big catalyst for gold. And the problem with China is, if their economy is struggling, their answer is print, more accommodation, more government spending, and that would lead to inflation over in China. Now, the stock market, you're right. The stock market, as we talk right now, is just closed a few points short of an all-time high. The all-time high, by the way, was set on October 29th, which was the last day that the Fed cut rates. And so at this point, I think we need to define the stock market two ways. There are the AI companies, and then there's the non-AI companies. I use Michael Kemblis at JP Morgan. They went through and they identified what they call 41 AI-related companies. It's the Mag 7. It's a couple of other companies along those lines. It's a few power companies that get primarily their business from supplying data centers with power, a couple of capital equipment maker companies, 41 of them. Those 41 companies are 47% of the S&P 500 market cap. The other 459 companies in the S&P are 53% of the S&P. Now, what I just said is one theme is half the U.S. stock market. When was the last time one theme was half or more of the U.S. stock market? The argument is, and I've looked at the data too, you'd probably have to go back to the railroads of the late 19th century to find the last time that we've seen a theme concentrated to that degree. The AI companies have been 70% of the gain of the S&P 500 over the last few years. The other companies, the other 459 companies have been only about 30% of the gain. Restated, the non-AI part of the stock market is up about 8% per annum over the last couple of years. Not a bad number, but we're all used to this 20% gain that the index has. That's largely because of AI. So we've got a transformative technology coming in right now in the form of AI, and that has gotten the marketplace to get excited to push those stocks up. Beyond that, you've been getting rather middling kind of stock market returns, 7-8% type of returns in the market. And you're right, in the initial stages of an inflation, the earnings look good. Companies can raise prices and they can fatten their margins. But as the inflation goes on, that reverses, because then something else happens. Their input costs go up, whether it's labor or raw material goods, especially if it's raw material goods from overseas that's being tariffed, they go up and they're going to start getting squeezed. That's why if you go back to the 70s example, if you go back to the late 60s, early 70s, people were openly saying the best inflation hedge is stocks because they can raise prices and keep up with inflation, so own stocks. And then by the mid-late 70s, that completely reversed and it completely went the other way, because it was, yes, but your input costs go up and your margins get squeezed and it's really hard to make a profit. And the stock market was a terrible performer until the early 1980s. And so that's where I think we are. We're in the early stages of the inflation boom. But even with that, the non-AI part of the stock market, which would be more inflation sensitive, is really, 7-8% returns a year. It's not the 15 to 20% that we kind of got used to with the overall index. That's because of AI.
Jim, let's come back to what you said earlier about socialists being elected and so forth. It seems to me what's going on here is in decades gone by, younger generations didn't vote and therefore didn't have much say in things. They were busy going to nightclubs and partying and having fun, and nobody voted. Therefore, the opinions of 20-somethings didn't really matter in terms of electoral outcomes. Seems like Generation Z is voting, and they're voting for socialists, and there doesn't seem to be any amount of, hey guys, have you looked at the history of this, and do you understand the reasons that the United States has been more financially successful than socialist countries? And the answer is they're not interested in hearing anything from old people. Okay, boomer, whatever you say, we don't think that your capitalist system is working for us. We're going to pick the opposite of it, whatever that means, and we don't really want to think any more about it than that. At least that's the way I perceive it. It seems to me like that's, they're more than half of the people. They're growing in their numbers. They're going to continue to dominate majorities as long as we have a democracy. Seems to me we're going to have more socialists, not just mayors, but congresspeople, and eventually move toward a socialist system in the United States. Am I wrong to think that's almost inevitable? And if it does, what's the long-term outlook for markets?
I think you're right. And I think you're right for the following reason. It hasn't been working for them. The widely quoted statistic that a lot of people have been saying is the average age of a first-time home buyer is 40. The reason it's 40 is you need to save for many years in order to buy a house. Prices, as I pointed out, are up 27%. They are finding it very difficult in order to make ends meet when it comes to prices. Then on top of that, you've got the whole idea about what AI is going to do to the labor market, the jobs market. I'm graduating with a degree from a recognized university. In other words, I'm not getting a basket weaving degree from a university you've never heard of. I'm getting a degree from the University of Michigan in business or something like that. Good degree, good school, and I'm not being able to find jobs. And what I've been told is all the jobs I would like to get, those entry-level jobs, are being replaced by a large language model. So they're feeling that prices are too expensive, opportunities are too few. And then here comes a guy like Mondami. We're going to have free buses. We're going to have cheaper grocery stores. We're going to put a cap on the amount that your rent can go up. And the boomers are telling them, well, that stuff doesn't work. And they're saying, yeah, well, what you're doing isn't working for me now. So why should I listen to you? Because I'm not happy that I got to save till I'm 40 to buy a house. I can't get a job because I'm being priced out of every job because of a large language model. I can't afford anything at the store now. And you're telling me that if I vote for this guy, it's going to be worse? It's pretty bad right now, is what they're trying to say. And so I understand that. And you're right. Until we can tackle this affordability problem, until we could show them that capitalism is the way to go. Look, I'm of the age that I came into the workforce in the early 80s during the Reagan boom, after the 82 bottom in the stock market, when the 25-year-olds all wanted to wear yellow suspenders or yellow ties and suspenders and get a job on Wall Street and make a lot of money because there was opportunities there left and right. That is not the case today. So I understand where they're going. You might refer to this as a fourth turning type of thing. And that, that we are in that fourth turning, that winter that we're going to see with the pushback that we're getting. So on one respect, I get it. I understand their frustration. I understand that lecturing them about the evils of socialism and the virtues of capitalism when they don't see it, is it really going to help them right now? And yeah, it might get worse until it gets better. Now, the way it could get better is we start to attack this issue. Take housing. How do you fix the housing problem? More supply. Well, the problem there is the president keeps yelling that the affordability thing is a con and it's a hoax and it doesn't exist and prices are coming down and things are becoming more affordable. That's not the way to answer that question about affordability. That you're wrong, everything's fine, is really what his answer is. So we're not going to address it, and we're going to have a pushback. So I hope that we're going to start to address it. We need more homes being built. The number that I've seen that I believe is from 2009 to today, there's been about 21 million new households formed in the United States, 2009 to 2025. There's been 18 million new homes built. So we have a deficit of about 3 million homes, plus probably another 2 million existing homes have been condemned and torn down because they were just old and in disrepair. So we might have a deficit of about 5 million homes. We need to loosen up, say, zoning laws, building laws, land use laws, in order to let contractors and let builders and developers build more homes. Problem is, the boomers that own the homes don't want to hear that, because that sounds like more supply, more competition. My house might fall in price. So yeah, we've got real issues we got to work through. And if Neil Howe was here, I think he would probably say, yeah, and that's exactly why we have fourth turnings. And maybe we're getting very close to one right now.
Well, isn't it true then? I mean, the fourth turning usually breaks down and replaces all of the biggest trusted institutions and so forth. Seems like we are indeed very definitely in the late stages of a fourth turning, because they last for about 25 years. The expectation would be sometime in the early 2030s, we kind of start the first turning with newly constructed systems that the younger generation is in charge of designing. And, it would be the millennials are in charge and Gen Z is doing all the work in order to usher in new systems to replace what we have today. I don't know, it feels to me like the feelings of Generation Z are completely understandable, but I don't think they really understand the consequences of socialism. What do? You could try to reach out to them and communicate with them, respecting their views, trying to engage them in a respectful debate about the benefits of different economic models and maybe why socialism isn't the solution. The thing is, Jim, the last guy who tried that was Charlie Kirk, and it didn't really end well for him.
I agree. I mean, what you have to do is, instead of lecturing them about the evils of socialism, do like what I saw when I was 23, 24 years old, in 1983, 1984. And that was the opportunities that capitalism was presenting, that you can get these jobs that could give you decent careers and get you moving along to being able to afford nice houses and nice things and do the things in life that you want to do. Show them the opportunities. Instead, we tell them socialism bad, save till 40, and don't complain about the prices at the store. I'm sorry, that's just the way it is. That's not a solution for them. So they're going to need to have something more than that. So hopefully we'll get to that point. You're right. In the first turning, maybe with large language models and AI being the transformative technology, I am a big believer that technology is a net creator of jobs. I've seen the studies that say 50 million jobs will be displaced by AI of 160 million in the United States. So roughly a third, maybe about 30%. Okay, I think that might be right. But I also think that AI might create 70 million new jobs. And those new jobs it's going to create are currently in industries that don't exist. And so maybe we could get to the point where we turn to the millennials and the Gen Zs and say, those 70 million jobs in those industries that don't exist, go create those. Go create those industries. Go do that. And you will, and that's the wave that your generation will ride, in order to become more financially secure, and not wait for the boomers to do it, or the boomers won't do it, or the Gen Xers to do it, because the Gen Xers are now starting to approach 60 years old anyway. The older ones are, at least. And so that hopefully could be where they're going to go with this in the first turn. And I actually think they will. And I think that, like I said, at the end of the day, technology is a net creator of jobs. The problem is I can identify the job that's going to go away. The job that it's going to create doesn't exist. So it's always a concept that it's out there. And but they usually are. And those jobs, go make those jobs reality. And so hopefully they will do that.
Well, Jim, I can't thank you enough for a terrific interview, as usual. Before I let you go, let's talk a little bit about what you do at Bianco Research. You are not actually running an ETF. You manage an index which WisdomTree follows with an ETF. So people who want to invest around your views and your strategy have a way of doing so. Tell us more about it.
Yeah, so I do manage. I'm a fixed income guy by training and by practice. And so we do manage the Bianco Research Total Return Index. You can find out about it at biancoadvisors.com. We set the parameters on the index, and WisdomTree has an ETF that tracks our index. I've used the example. Think of me like the head of the S&P 500 Index Committee, and SPY tracks my index. Well, that's kind of the setup that we've got. WTBN is the ticker symbol for the WisdomTree Bianco Fund, and My day job still exists, is as being the researcher of Bianco Research. You could find out more about us at the words Bianco Research. Either biancoresearch.com is our website, Bianco Research on Twitter, Bianco Research on YouTube, either Jim Bianco or Bianco Research on LinkedIn. And so you could follow me on any of the socials. I try to stay active on the socials as well, too, or check us out on our website.
Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jim back on the show. Listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Jim's picture saying looking for the downloads.
Patrick, you pimped your new Asymmetric Trading Challenge product on last week's show, but how about giving our listeners a solid example of an asymmetric trade design by translating some of Jim Bianco's views into a trade with more upside return potential than downside risk if it doesn't pan out?
Eric, what really jumped out at me in Jim Bianco's comments is that the bond market is not behaving the way a classic easing cycle says it should. The Fed has already cut aggressively, and yet the 10-year yields are higher than when they started cutting. So for this week's trade of the week, I wanted to build a trade for those who believe that the bond vigilantes will ultimately prevail. Now, when we had Jim on a few months ago, we expressed his view with a bear steepener of the 5/30s curve. That chart is on page 2 of the deck. Today, I want to come at the same theme through a short, long duration U.S. Treasury position using options. On page 3, you can see the 30-year U.S. government yield chart with a very clear resistance around 5% over the last 2 years. If bond vigilantes reawaken the way we saw with the JGBs or gilts, it's entirely plausible they'll make another run at the 5% level, if not higher. The key to using options here is on page 4. Implied volatility on the TLT long bond ETF is sitting down at its lows of the year. This makes this kind of convex expression much cheaper to put on than almost at any point earlier in the cycle. So I'm looking for a capital efficient, risk-controlled way to profit if yields break above 5%, which is where I think volatility will start to get spicy very quickly. Now, the structure I'm looking at is the July 2026 TLT 85 by 80 bear put spread. We're long the $85 put and short the $80 put, paying about $1.20 for a $5 wide spread. That gives you a better than 3-to-1 risk reward profile if long yields move higher and the TLT trades down to the low 80s or below, with your maximum loss strictly limited to the $1.20 capital outlay. It's also worth noting that anyone currently long TLT shares on an economic contraction thesis can use the same spread as a hedge overlay. It's a relatively inexpensive way to dampen the downside if we get a breakout in the long end yields that runs counter to the duration bet while still keeping your core long bond position in place.
Patrick, where should our listeners go if they want to find out more about the Asymmetric Trading Challenge?
Eric, we're hosting a one-time special webinar on the Asymmetric Trading Challenge we're running for 2026. We are hosting it on Tuesday, December 16th at 4 p.m. Eastern Time. It is free to attend, so if you want to reserve your spot, go to our homepage, bigpicturetrading.com. You will also find the link in your Research Roundup email. All right, Eric, let's talk about these equities.
Well, Patrick, we got the long-awaited, widely anticipated December rate cut, along with the predictable instantaneous spike higher in the S&P index in a brisk, face-ripping rally that lasted for a good hour and a half before it fully retraced to the downside, and then some, with S&P futures trading in the overnight session below where they stood at 2 p.m. when the rate cut was confirmed. So now the question becomes whether that rate cut will be the predicted catalyst for a Santa Claus rally that takes the S&P to new all-time highs by New Year's, or if maybe it was actually a sell the news event that marks the short-term top just 90 minutes after the cut announcement, and which might not be exceeded again before year's end. Now, only time will tell, but the brevity of the immediate upside reaction suggests that the latter scenario could very well be in play.
Well, Eric, what we've seen over the last couple of weeks has been a complete contraction of realized volatility. This dampening is somewhat to be expected as we've moved far away from trigger points on this market and now approach some key overhead resistance. The key was that so far the market hasn't done any extraordinary move in the post-FOMC period. This puts that jobs number next week in line, but with option expiration next week, if the jobs numbers are not an outlier that causes a big swing in the markets, it's very likely we're going to pin into the option expiration. And at that stage, with the low volume over the holiday period, it's very likely that the rest of the month of December could be stuck in a brutal, choppy trade range, leaving the next major market move to the new year. Let's see if that happens. Obviously, we have a big hurdle to pass with that jobs numbers released next week. But if it isn't an outlier, odds are very high that this is going to be a pretty boring month for the stock markets. All right, Eric, let's talk about this dollar.
Well, the Dixie's not crashing, but it's looking more and more like a short-term top is in, and we're well into a swing trade lower, at least for now. As I've said before, I think the action on the dollar is going to be headline-driven, and Trump and Bessent's next policy moves will likely determine the direction of the next major leg for the dollar. Absent policy action, looks to me like a new down channel is being established on the chart.
Well, Eric, the U.S. dollar has been weakening. We spent 2 months above the 50-day moving average in a retracement that should have even gone as high as 102, 103 on the upside. Instead, the 100 level acted as substantial overhead resistance, and now we're breaking down towards the critical 98 level. And I want to stress, to me, the 98 level on Dixie is real tell, because if we see that the market is interpreting the Fed path to still have a relatively dovish tone, and we give out the 98 level, there's a real chance that the dollar could resume its downwards trend that's been in place all year long. Would that mean a break to fresh new lows? Well, at this stage, we're sort of in a no man's land in the consolidation. The next real major support line for the dollar index was established over the last decade down along the 90 level. So if we see any deterioration in this trend over the rest of December, it could reopen the downside window of the dollar into next year. All right, Eric, let's touch on oil.
Well, it's getting really interesting despite Cushing inventories being at operational minimum. So that means shortage of oil. We should see big backwardation on the front of the curve. We're actually seeing front of curve time spreads softening. That's a bearish sign. So my outlook is unchanged. The fundamentals here are decidedly bullish. I think we're at the beginning of a secular inflation. I think there's lots of reasons, whether you look at the Cushing inventories or lots of other fundamental indicators that are decidedly bullish. But I also see room for invisible hands to keep oil prices low through the midterm elections. And the Trump administration is very, very strongly incentivized to keep prices at the pumps low through November's elections. Crude's seasonal low is normally in February, so I'm definitely not in any rush to put any longs on before then. Now, a dip down to, let's say, $50 WTI would be hard to resist. 45 would be really hard to resist because I'm convinced that the fundamentals will eventually carry this market higher. But right now in the high 50s, the question in my mind is how long the Trump administration can delay that inevitable outcome of a move much higher in oil prices. And I think the answer is probably quite a while. Time will tell.
Really, there's no other way to put it. It's been an incredibly boring trade range. Now, there's been no momentum breakdowns. Usually when you trade this way below a 50-day moving average, there should have been easily a breakdown to 55 or even down towards 50 with this type of price action. But instead, it's been a consolidation sideways. It's almost like oil has found a new fair value zone. And while there's no catalyst to take it higher, it doesn't seem to be in any rush to break down. Now, obviously, some sort of a news catalyst will likely break this trend. I want to observe that the prevailing downtrend is the dominant one. There has simply been zero sustained buying at any point, but it is a consensus trade to be short. There's very little interest in this, and all CTAs are positioned on that short side. So if whatever catalyst was ever introduced to create a short squeeze, it can certainly be the pain trade that emerges on the market. But right now, there's zero technical evidence of that. At this stage, this might be the story of continuing sideways for the rest of the month. All right, let's jump into gold.
Well, the rally in gold after the Fed cut lasted much longer and didn't retrace nearly as hard as the retracement in stocks. The short-term overbought signal is being shaken off by time rather than price, with a sideways price consolidation for more than a week now, causing the slow stochastics to retrace back down to about half-mast. So I think the rally toward new all-time highs is probably on, but there's still plenty of room for more consolidation before the next big leg higher begins.
Well, gold is trading a stone throw away from its 52-week highs. It's been very well accumulated, holding up there, and maybe in this post-FOMC period, and especially in the post-jobs number period, maybe gold will have the tailwind to potentially break out to a fresh new high. This will be yet to be seen. I think I'm going to reserve my market call on this next week when we post that news, but it is noteworthy to talk about silver, which I have on the chart deck on page 10, and what we see is a continued parabolic rise in silver prices. We've now hit $62, which is a basic measured move target, but there's a bigger measured move that is all the way up to the $70 mark. This is clearly being very well bid. Every little dip gets bought. Consolidations are sideways, and breakouts to new highs happen almost immediately. This is a market that continues to take flows, and it's certainly giving a bullish tailwind to all four of the precious metals. All right, Eric, let's touch on uranium.
Well, as I said more times than I can count, I couldn't possibly be more bullish about the long-term fundamentals for uranium and for nuclear energy generally. And while this consolidation has been a little bit frustrating, the weekly chart's really starting to look great in terms of oversold stochastics setting the stage for another big leg higher. The sticking point has been the spot price of uranium, which was stubbornly unchanged for more than a week, but which is now finally, as of Wednesday's trading action, just barely started to tick up. Let's see if we can sustain a rally in the spot price, because that's what's going to give the next leg up for the miners.
Well, Eric, when I'm looking at these pullbacks in the uranium stocks and in uranium itself, we've now seen that overbought state get completely unwound, and in some cases, some oversold readings coming out on the markets. We've seen already a 50% retrace of the rallies. So the asymmetry has reset in the uranium markets. The bigger question is, does it start on the upside in a big way here in December, or is it going to be a January story? Overall, the very overbought state is gone. And so now it's just really about setting up where could a potential new bull breakout really get underway.
Patrick, before we wrap up this week's episode, let's hit that 10-year Treasury note chart.
Finally, Eric, just touching on that chart on the 10-year yield, and what we have seen over the last 6 months was a sequence of lower highs and lower lows as the yield worked from the 460 level all the way down temporarily below 4%. Now we have seen that pattern slightly change. Majority of that decline, the yield stayed below their 50-day moving average, just simply depicting the trend of lower rates. We have seen that descending trend reverse here. And so this is the first time in half a year that we've seen a higher high on yields. The bigger question here, is this a turning point? Is this where we're going to see that 10-year make a push back to the highs where it was earlier this year? That's the puzzle to solve. Certainly, this is the first time the price action has pivoted this way. Let's see whether or not the jobs numbers really shake up this 10-year to follow through on the upside.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the link to the asymmetric trading challenge that we talked about earlier during the trade of the week. You'll find the chart book we just discussed here in the post game and a link to a number of articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make this program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we'll consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.